Hello there, welcome to Berman's Call. Larry Berman is here to take your questions on large cap stocks and ETFs. Let's put up the coordinates, 1-855-326-6266, or email Larry at bermanscall@bnnbloomberg.ca. Larry, thanks very much for joining us. We've seen quite the swing in the markets, the S&P moving into positive territory, the NASDAQ too. We'll put up some intraday charts. What is all this volatility telling you?
It tells me I should be back on the beach in Fort Lauderdale. Listen, the market got hit by, not unexpected because we knew tariffs were an issue, but the process has been very, very disruptive in terms of how they're going to negotiate with all the countries in the world. We've heard from business leaders, we've heard from market participants over the weekends. Nobody likes this. So I think before Congress steps away for the session on Thursday, I think we'll see something out of Washington or the White House in terms of a better path forward. But I sit here with my fingers crossed like this because I hope that happens. If we don't have a resolution and Congress is out, it's more market volatility. Now in market volatility, there's always opportunity. And it depends how you look at it. If you want to be an ostrich in the sand and put your head in there and not look, or do you want to look for things that are mispriced? And I think it's much, much better to look at it from that perspective and say, well, what didn't I want to buy a few months ago because it was expensive? Like, listen, NVIDIA dipped below 90 today. That's pretty good, actually. And as soon as that headline came out on, well, we're going to push tariffs back, NVIDIA went over 100. Now it's back again a little bit lower, but still up on the day. So look for the great names that you want to own in your portfolio that maybe you didn't want to own at 140 or 150 that are on sale. Start nibbling on them. My technical indicators I'm going to cover that on the educational part of today's show, are saying as much.
What was the timing factor with Congress that you mentioned, Larry?
So I think it's Thursday that they're out for a month, and we need some kind of resolution here. So Grassley's putting forward a bill. Trump threatened to veto it. We heard some headlines out of the White House, but turns out they were not from the White House. And so that's what we're going to have in the next couple of days. But I think the market's response to those positive headlines is a message for the White House that you can fix this thing. You don't have to let it get a whole lot worse. And, let's do it the right way.
We've the likes of Jamie
Dimon and Larry Fink, a lot of them were out
saying, ease up here.
This is not what we voted for, Mr. President. Let's get it done in a very professional way. What he's doing now is completely unprofessional. The way they came up with the calculation for the tariff rates has been completely discredited by just about everybody on the planet except for the White House. So, that's the reality of where and why we're here and why we had record back-to-back down days, in the stock market.
Insofar, though, as Trump's base are lower income people, do they care about the stock market dropping?
They should care about their jobs because if the stock market drops to the point where it causes a recession and you get retrenchment in the consumer, a lot of those people are probably going to be out of work. So they should care. They may not care about their 401k. They may not have much of one, but they should care about their employment. It's all linked together.
Have you ever seen anything like this, a U.S. president launching policies that have caused...
Well, I wasn't around in the 1970s. I imagine Watergate. I imagine there's the 60s with the wars. I imagine there was this stuff. It was a different name on the door, different event, but nonetheless, Washington doing what Washington doesn't always do well.
Yeah, I mean, Nixon abandoned the gold standard and stuff like that. And Bretton Woods, of course, they walked away from that. Yeah, that was disruptive. Yeah, incredible. So your view, the stock market, there's buyers and there's sellers. Look out for stocks that you liked a few weeks ago that you thought were expensive.
We've been very cautious through this market melt up. I sometimes get hate mail when people say, Larry, what are you talking about? Artificial intelligence. I get it all. Now it's cheaper. So let's look for those opportunities now, because this correction, whether it was this as a catalyst or something else, was always going to come. Why? Because it's normal, right? Now, how it happened this time around is different than last time and the time before and the time before, but it always happens. So you've got to always keep some powder dry so that when it does happen, you don't put your head in the sand, you look for opportunities and you take advantage of the volatility as opposed to fearing it. If you're fearing it today, you just don't have the right portfolio for your long-term goals. You shouldn't be worried by this kind of market disruption.
We're going to get to your phone calls and emails for Larry, and there's that number again, 1-855-326-6266, or there's the email address, bermanscall@bnnbloomberg.ca. Email from Dennis. Are there a lot of foreign components in the ZWU ETF? Do you still consider this one as a sleep at night pick? And so this is the covered call utilities, Larry?
Yes, it is. And so as much as sleep at night can be these days, I woke up at 2:30 in the morning last night. It does. It has AT&T in it. It's got some pipelines, Kinder Morgan, Verizon Communications, for example. So it has about 30% exposure to U.S. telecom and pipelines, and then 70% Canadian. So most of your dividend is coming from a Canadian source, but there's about 30% coming from the U.S. So that's the message there. Is it still sleep at night? Absolutely. It's been a very defensive place for me to be in my portfolios. But I'll tell you, Andy, in our sleep at night portfolio, on Friday at the close, we sold some ZWU to get a little bit more aggressive in the portfolios because some of the areas that we've avoided because they were a little bit more overvalued kind of stepped into a little bit on Friday. So inching in, and this was one of the things we sold. Not that it's bad to hold at all, but it was my more defensive holding. And it was a good opportunity to get a little bit more aggressive.
Okay. We have Nazar calling from Scarborough, Ontario. Go ahead, Nazar, please.
Oh, hi, Andy. Hi, Larry. May I have your thoughts on Royal Bank, please? All the big banks have fallen. Is this a good time to pick up Royal at $154 at this time, or wait a little bit more for the market to settle? Thanks for taking my call.
Thank you.
Yeah, so one of the things I bought was rolling out of ZWU into ZWB, which is the covered call banks. But again, it's just a first kind of tranche in, not a full position. But I haven't liked the banks for a number of months at higher levels. Royal's my least favorite here. It's the most overvalued relative to some of the other ones. So I think there's some better values in a TD, for example, that's been beaten up a little bit over things that are unique to TD, for example, at the moment. Bank of Nova Scotia, I think there's a little bit better value there as well. So the answer's, sure, a little bit, but I'm not, I would wait a little bit if it's new money and you have some patience. Probably get it a little bit cheaper than where we are here. 130, 140 range, I like it a lot.
Okay. John in Toronto, go ahead, please.
Hi, Andy and Larry. Good afternoon, guys.
Hi.
Thanks for taking my call. Larry, I have a question regarding options. So I have some put spreads on 4 or 5 of the Canadian banks, and of course they're in the money. Expiration time April and May. And what I'm trying to determine right now is the strategy moving forward to neutralize the losses. Would you just roll these to another expiration date, and to June or July, Or would you, on the other side of this, write some call spreads to turn these into iron condors?
Okay, so there's probably a little bit more to get very specific. I would need to know from the question as to what might be more appropriate. But it seems like you're hedging long exposure to your underlying bank stocks by owning put spreads. That's great. One of the things I like doing here is actually, buying into weakness. So depending on where the call strikes are or the put strikes are, you would take your profit on the long end where you've protected, expose your naked put to adding to the position. I like doing things like that. I'm not sure what's appropriate for the caller here. You have to look at the price of volatility in the short run, the near-term expiries, versus what you're going to pay to roll those out to the back months. Is that an expensive trade or is it a cheap trade? There's a lot to unpack. It's a great question, but it's not something that I could answer very specifically in 30 seconds, unfortunately.
In a time like this, Larry, though, you're writing any kind of option. Are you likely to get a pretty good premium with this volatility?
Well, that's exactly right. And that's how options are primarily priced based on the volatility of the market. I wouldn't be selling calls here because I think you want to sell calls market's up, not when the market's down. So I would be a little bit patient on that. So you may want to roll them out, wait for a bounce, then sell your calls. Again, I don't know what's appropriate for you and what your ultimate goal is. So very hard to get too specific.
Kai is calling from Toronto. Go ahead, Kai, please.
Hi, Larry and Andrew. Thank you for taking my call.
Pleasure.
Larry, my question is on Microsoft. When I started nibbling away at tech stocks years ago, I heard an analyst here on the channel describe it as the utility stock of tech stocks. And now I'm just wondering, is it a case where the baby's been thrown out with the bathwater here? And would you recommend taking a bigger position on Microsoft? Thanks very much.
Thanks.
So one of the things that I do when I look at it, any stock, is, where's it valued today relative to its 1 year fair value, 3 year, 5 year, and then I kind of make an assessment. So at the recent highs, 450-ish, I didn't love it. I didn't like it. To me, it was very overvalued. Now it's starting to get closer to more neutral value. If we think about it on trend, if I could get a 5-year or chart on Microsoft, that would be very helpful here. Because when you think about the recovery off the 2022 lows, go even further back here, but there's a trend line that's coming up that kind of looks like that. So, for a trader, there's a good opportunity here. We could argue that if this trade things persist, that we could easily think about coming back to some of these levels. I'm not forecasting that because I don't know what's in the president's mind. I don't know how hardball he's going to play here. But that could be a very real scenario. So you've got to judge the quality of the names you want to buy. Microsoft's a great company, don't get me wrong. But I'm very underweight the name. And I would be adding to it a little bit here. But I don't think we're free and clear and stepping in a big way yet.
Is there any...
Because at the recent highs with 35 times earnings, very expensive for Microsoft.
Right. Is there any case to be made, though, it's a defensive name among techs?
Not at 35 times earnings.
Okay, yeah.
At 25, okay. At 35, no, sir.
Okay. We have an email from Dion. I was wondering about your thoughts on ZBAL, T-Series. It's targeted to retirees. What about somebody who's got a horizon of 15 to 20 years? 15
to 20 years for the average investor, depending on your risk tolerance. I would argue that you don't need any fixed income in your portfolio because it really depends on your level of risk. ZBAL is a 60-40 balanced portfolio. Most people are taught to think about balance. But what bonds were a decade ago, 2 decades ago, 3 decades ago in terms of what it did for the accretive part of your portfolio? If we're in an era of inflation, and it's going to be more persistent for a decade or two to come because of less globalization, because of tariffs, the bond part of your portfolio is going to fail you. Okay, I would much rather to manage risk be in these very innovative strategies. BMO has some of them where they give you all equity potential, but they give you a buffer in it to protect your risk. So it acts like a balanced portfolio, but you get a much better long-term upside potential because it is really all equity. Even though those annual gains are capped, it's going to be much better way of getting balance or less risk for the average investor than looking at a 60-40 type portfolio.
So you're a skeptic on bonds if somebody has a horizon of, say, 15 years?
Skeptic is not the word, and that is an understatement. I think as a safe asset class, I've been talking about private credit for years. People have got to start moving into that space. Fixed income has been terrible for a decade. It's going to be terrible for a decade more.
We have an email from Ravi. Is there any safe alternative to GICs for sheltering cash for up to 1 year?
Everybody loves their safe money. With the Bank of Canada cutting rates, money market rates are coming down. The government rate right now is 2.75. Their next meeting, they're 60-40 right now, I think, for a rate cut again. So that rate's going to keep coming down. So how can you do better than that? You can get a dividend and get better tax treatment, right? So you want your safe money, it is what it is. There are real no super safe extra yield strategies publicly without an additional layer of risk. So there's no guaranteed investment certificate, but give me it with much higher yield, please. Right? Like those things don't exist. You will get teaser rates. Some of the, tier 2 financial institutions will offer you some premiums to get into those. Those are but then you're typically locked in. You don't have a lot of liquidity. What do you need the cash for? So the answer is no, they're not really great alternatives. There's some ETFs. They used to be these high interest savings premium ones. Government of Canada got rid of all those benefits. So very, very little out there.
Okay, we have an email from Tom. Is it better to have exposure to the private markets by investing in publicly traded private equity firms, for example, KKR or Texas Pacific or Onyx, rather than illiquid private funds?
Yes and no. Can you handle the ride? Bring up a KKR 1 year if you can.
Okay.
Okay, so President Trump gets elected. Less regulation. It was going to be great for PE companies. These stocks rip. And when I mean rip, they ripped. Okay, so I don't see a chart yet, but if you can bring up KKR, great.
There you go.
President Trump gets elected, stocks rip. Oh, tariffs are coming, slower economy. So if you can handle the ride, you'll do better in these in the long run for sure. But don't buy it here, buy it here, buy it here, and so forth. So I like it now. I'm nibbling, I'm adding to positions here where we have exposure in some of the public companies that are played in the private equity space. But you have the full volatility of markets, you have the liquidity of markets. It's not the same when I'm saying get into private equity or private credit. When I'm talking about those are vehicles that price monthly, quarterly, annually. You lock up, you earn a illiquidity premium, and you get a much smoother ride. You act like a little bit more like a pension plan in terms of incorporating that stuff into your portfolios.
We're going to take a break. Coming up, Larry's educational segment.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Time for Larry's educational segment. Take it away, Larry.
Andy, you might remember about 5 years ago, we started publishing the Berman's Call Pro Eyes indicators, and it was a website we put up under the Berman's Call website banner. And this was an indicator of 20 different market-related ways of measuring sentiment, tactical trading, market valuation, business cycles. And we spent a couple months actually educating people about it. I haven't talked about it in quite a while because I've been very, very cautious. The indicator has been a bit defensive. But this weekend, and we update it once a week, and it's designed to be like the CNN Fear and Greed Index. market starts correcting last couple of weeks. Last week, very intense. This indicator takes all the 20 different factors and then says, should we be cautionary? And for the most part, late last year as the market was rallying, it was like cautionary, don't chase this thing. There's some valuation issues, and the momentum was waning on us.
So when it goes up, it's sounding a cautionary note.
It's cautionary.
Okay. Yeah.
Now, in 2022, COVID, we can go back and look at the flash crash. We can look at all the corrections over history and say, we're now in an area where there's much more opportunity. And that's what I was saying at the top of the show. So start putting your favorite names on the front burner, looking to add to them during crazy days, right? And so the overall index is, but keep in mind, it could be a couple of quarters of this, up and down, up and down. What the indicator doesn't tell you is how long it's going to last. It just sets the environment. So we're oversold enough for a trading rally. Let's look at just the technical component, because we have valuation, we have business cycle, and then we have all the trading tactical indicators. So this is our trading one. We're based on technical indicators, and it's as oversold as it ever gets, setting up for a trading rally. So I think we're set up for a bounce. We do need the headline out of the White House or Congress to say, we're going to do this a little bit better. And as we saw this morning when that headline hit, markets ripped.
A false belief that he was going to postpone the tariffs.
Right,
Yeah,
that
or
one.
he was open
We need
to
a
it,
real
yeah.
one.
Yeah, exactly.
Right?
Yeah.
So we'll get a bounce here, but it's probably going to be to a much lower high. The biggest resistance is going to be around 5,500. So where we broke down from just a few days ago after his wonderful tariff news. So bounce is probably limited to 5,500 at this point over the next months at least, unless we really solve this thing. But technically, we're very oversold. Last chart here, if we look at the levels, so overnight futures contracts, so this is looking at the S&P 500 futures from the 2022 bottom to the high earlier this year, the whole bull run, we retraced overnight 50% of the rally, big technical level. It also happens to be the high from 2021. So from the high in 21 till last night, markets made nobody any money, lots of movement in between. So we now have this good support. We're very oversold technically. It's a good level to buy into, but it may not hold. I don't know for sure. There are other support levels, next one being around 4,500. And if you're really cautious, somewhere in the low 4,000s is where we could end up if they don't play their cards right here. So it's not a free and clear, but it's a tradable rally here. And I think for the traders out there, not a bad opportunity.
Larry, thanks very much indeed. Let's just remind you where you can follow Larry online. He's on YouTube, he's on LinkedIn, and his websites are etfcm.com and qwealth.com. Larry returns every Monday at 3 p.m. Eastern. You can get your questions in right now. Email us, Berman's Call at bnnbloomberg.ca. The close is up next.